Alrighty, so a REIT is an acronym for a real estate investment trust. There we go, guys, done and dusted. Thanks for watching. Just joking, there is more, so please don't click away. My friends, you've found yourself watching the Money Playbook, where we aim to help you learn about the world of finance. If the world of finance excites you, make sure you're subscribed and you destroy that like button. Now let's get straight into the facts. A REIT is typically an organization or company that works and invests within the real estate industry in order to make a profit. These companies can and normally trade on the public stock market. Due to the huge size and capital these organizations can obtain, they are able to buy incredible amounts of real estate and essentially build empires. That meaning that they can own real estate in the residential, commercial, and industrial area. Within that, many REITs tend to specialize in certain areas, whether that be, say, a commercial shopping center or residential apartments, buildings, etc. REITs can be split up into three main classifications of how they make their money. The first classification is what is called an equity REIT, and this is what most people would think of when they first think of how a REIT would make their money. These REITs look at building an income based off a property portfolio, this being they earn money off rental returns or capital gains. Now the next type is a mortgage REIT. These can be a bit more confusing, but I'll dumb it down for the sake of this quick video. A mortgage REIT basically means that they become a bank for a real estate property borrower. That means they will lend their money to clients looking to strictly borrow money in order to buy real estate. They then create an income off the interest that are paid back to them for loaning their money. It's a pretty cool concept. And the last classification of REIT is called a hybrid REIT. And for you geniuses out there, yes, a hybrid REIT is quite simply combining both profit methods that equity and mortgage REITs use. Now your next question may be, and suck it up if it's not, but how can you get involved in a REIT? And it is quite simple. Just like shares in Apple or Tesla, you can buy a share in a REIT. Essentially, it is a stock. You own a fraction of that REIT and therefore you are entitled to any profits that they will pay out as dividends or any capital appreciation of that REIT's price. And now your next question may be, well, what is the difference between a REIT and investing yourself in real estate? Well, I'm glad you asked, and the answer is yet quite simple, and I'll just break it down to you in categories. In real estate, you're essentially the organization that has ownership over the property legally, opposed to a REIT in which you don't really own the property, you own a portion of the organization that owns that property, so then hence you own a tiny fraction of all the properties that they manage. So hypothetically speaking, if your REIT owns 5 40-story buildings, you may own one window in one of those 40-story buildings. In order to further compare the two below, we will go into similar comparisons and a list of differences. So the first difference we will start in is the costs. If you're sitting there with only a few $100s in the bank, chances are you think of your chance of buying real estate are absolute toast. However, this is where a REIT can come in handy, as you can own millions and millions of dollars worth of real estate, all for that $100. Okay, there is a little catch. You own this property with thousands of other people, hence you only get a tiny slither of that pie. This is where a REIT's entry point differs largely from real estate. You could get a small share in a REIT for under $1, opposed to if you invested yourself in real estate, in which the entry in price is usually tens of thousands of dollars. That's a big difference, eh? And that, more times than not, is just for a small deposit, in which you then have to take on debt in order to purchase the actual property. Our next compare the pair comparison, if you get that reference, comment below. But the next comparison is the control. The levels of control between real estate and REITs are polar opposites. When it comes to a REIT, you have pretty much no control over the property or where your money is going. You are buying pretty much the organization's portfolio, hence you have no say in what properties are being bought, sold, or kept. With a real estate investment trust, you are buying with the mindset that once you have researched that particular REIT, you're investing your money into the organization's business model. You're basically saying, here you go, here is my money, I trust you with it, now please give me something in return. Whereas with real estate, you have complete control over the property. You decide what property you want to buy and what you want to do with that property. It is all up to you. Which leads me to my next point, which is the time involved in each one. As mentioned above, you can probably assume that the time involved will correlate with the control. That being, with a REIT, the organization or company you invest in take care of everything when it comes to the property management. Investing in a REIT will turn into a passive income stream where your money will hopefully give you a regular return. The opposite goes for a real estate investment. If you decide to go down this path, you can find yourself investing a lot of time as well as money into this investment. This is because you own the property. Therefore, it is your responsibility to say fix any damages that can occur to your property or collect payments from tenants. So this can become a ginormous factor to consider if you want to invest in a REIT or invest by yourself. Our next point of difference that you can make is diversification. For investors, this is huge. It is a huge difference between REITs and real estate investing. Diversification, put simply, is not having all your eggs in that one basket. Meaning, if you just invest in single-family residential homes, you are not very diverse, but more specialized. When it comes to a REIT, many of the organizations or companies you invest in will be actively looking to diversify their portfolios. They may own properties in all sectors of residential, commercial, and industrial, or they may diversify within a sector, for example, the commercial sector. They may own properties that are built for being gyms or hospitals or cafes or retail shops, etc., therefore minimizing the risk to say if one of those sectors begins to fail. This differs to real estate investing. As for the majority of investors, they may, for example, only own 1 or 2 single-family homes. This is very much putting all your eggs in that one basket, and there's not very diverse at all. It could pose a huge risk for, say, if the market for single-family homes just suddenly disappears. It does, though, become very hard to personally diversify your real estate portfolio. This is due to the large amounts of money required to spread into multiple sectors of real estate. And now our last comparison between the two is the return or risk factor. So for you smart cookies out there, I bet you can fill in the blanks with this one. This is when you invest in REITs, your risk can be seen as much less than if you invest in real estate. Why, you may ask? Well, when you invest in REITs, you can only lose whatever money you initially chose to invest. Whereas with real estate, if you've chosen to take on debt with your investment, it then becomes your responsibility to pay it all back. If things go belly up and you're forced to sell back your property at a lower price than what you bought it, it is your responsibility to pay back all the debt that you own on that property. This means that you can be digging deep into your pockets just to repay that debt. However, by taking on this risk, you are opened up to the biggest positive when it comes to real estate investing, and that is the huge reward. You own that property, therefore if the housing prices sharply increase, or even increase greatly over time, that is your wealth you are building. Every single dollar your property goes up goes straight into your pocket. This is opposed to a real estate investment trust, where if say those property prices increase, the returns are not all yours. You would only receive a small fraction of those profits by usually an increase in dividends or an increase in the REIT's share price. The big boys that are sitting in the office are making the real cash when it comes to REITs. So smash that like button now if you have an understanding of what a real estate investment trust is and how it differs from investing yourself in real estate. As always, thank you for watching, guys, and if you want financial freedom, financial literacy, or further help to succeed in your life, make sure you're subscribed to the Money Playbook and turn those post notifications on. And remember, guys, if you're not growing, you're dying, which basically